All right, so both methods minimizing WACC or maximizing share price will happen simultaneously. So that means the company has achieved optimal capital structure. All right. All right. As you can see, another illustration. The amount of borrowed is increased. That means your overall percentage from 0% until 50% funded by debt. All right. So when a company has 0% debt, it means 100% is from equity. All right. So if it's 12.5% debt, means the remaining is equity. So now your cost of equity is 12%. Cost of debt is 0 because no debt. And now your overall cost is 12%. Plus, without debt, your total overall cost of equity equal to your overall cost for the company. Okay, now you have taken debt slightly, then your cost of equity, as you can see, from 12% it has increased to 12.5. Right? Why? Companies here they only face business risk, but now here they face business risk plus, can you guess it? The financial risk. All right. When you take debt, a company faces financial risk. Therefore, you have to pay. You have to compensate the shareholders with higher return. Right? And here your cost of debt is 0 now. Is 4.8 because see the difference. Your cost of equity is 12%. Your cost of debt is only 4.8. All right, because when you minus the tax advantage, your cost of debt is always cheaper compared to equity. All right, and the overall cost, you see, basically this is 87.5% times cost of equity, 12.5% times 4.8%, you get 11.55. See what happened? From 12%, your overall cost for the company has reduced 12 to 11.55. And the reason it has reduced is because now you have taken cheaper cost of financing, your cost of debt. All right. Now you're taking more debt. Now you have 20% is funded by debt. The remaining is equity. Of course, your cost of debt, cost of equity increases, and your cost of debt also increase. Even the banks will say the company is higher risk since you have debt, right? So you need to pay. You need to compensate with higher return. So even the banks will charge higher interest. But your overall cost has reduced because your portion from 12.5, now your interest is 25%. So of course comparably is still, your debt is still cheaper, right? But of course you want to take more debt, right? Since it's cheaper, you are taking more debt. But what happened? Your overall equity, cost of equity increases, your cost of debt increases. And what about the overall cost? It was reducing until here, but after this point, it is increasing again. And of course, if you see further, it has increased almost as the initial stage. All right. So the position where the company reaches the minimum or the minimize your cost of capital is what we call as optimal or optimal capital structure. So what was the capital structure? 25% debt, 75% equity. So this is the optimal capital structure for the company. All right, not 100% equity or not 50-50. It's 25% debt, 75% equity. So that is the optimal capital structure. And how we know? By looking at the overall cost of capital, right? All right, it's the same illustration. So the only difference here is here they are showing share price. All right. So in the beginning, your share price is only 25. But when you're taking more debt, you see, your share price increases. Now, increases further. Alright, this is the portion for the optimal capital structure, which was 25% equity, 75%, 25% debt, 75% equity. So it's the same. Alright, so same level. As you can see, your share price compared to the rest is at the highest. Alright, so remember, your WACC should be the lowest while your share price would be the highest. Alright, so this position is what we call as optimal capital structure. Right? Alright, so of course, if you can see the earning per share in the previous slide, alright, compared to the other capital structure, of course, the one with the 50% debt, 50% equity has the highest earning per share. Alright, for every share, you give them the highest earning. Alright, but you have to remember, even though it gives the highest earning per share, but the risk is too high. The debt is 50%. Alright, so your very high commitment of fixed interest payment. So when the company doesn't do well, then you have very high chances of going into liquidation, liquidity problem, or bankruptcy problem. Okay. So the previous illustration is basically from this company called Campus Delhi. So what was the capital structure? It is 25% debt and 75% equity, right? Alright, of course you can say the share price maximized at 25%, but EPS is maximized as 50%. Okay, but remember, our primary interest is the share price, right? Maximize shareholders wealth, and the indicator is share price. So we are interested in this, not the EPS. Okay? So the example shows higher the debt, higher the earning per share, but that will increase your leverage. Okay, and the financial risk. What if there were more or less business risks than originally estimated? How would the analysis be affected? Alright, so here, if a company has already have high business risk, okay, if a company already have a lot of uncertainties with revenue, uncertainty with the cost, uncertainty with the sales price, it's all the uncertainties we have learned before, the business risk. If you already have high business risk, then if you take debt, that will definitely worsen the situation. Alright, if your business risk is already high and then you are taking more debt, that will end up making the entire situation of the company to be worse. Alright, so you only think about taking debt when the company has lower business risk, so that it can achieve optimal capital structure, not when the company has higher business risk. Okay, so we're going to the last slide, where what are signaling effects in capital structure. Signaling effect means when a company does certain actions, like the company issuing more shares in the market. What does it signals? What does it tell to the signal? What does it? What kind of effect does it shows to the market? So let's look at that. If a company issues shares instead of taking debt. Okay, what is the implication? So before going to that, into the effects, the impact, we look at the assumptions. Managers have better information about the firm's long-run value than outside investors. So we always assume the internal people, the managers will have better information about the company compared to the investors, right? Managers act in the best interest of the current shareholders. So we always assume the managers act the best interest of the shareholders. So what can managers be expected to do? All right. If company issuing shares, all right, if the company issuing shares, instead of taking that, if let's say the company issuing shares, that means the company's shares is overvalued. Okay. What does it mean overvalued? Let's say the company's value should be valued at 5 ringgit. Alright, based on the current situation, the market, the asset and everything, we are only the interest rate which should be only 5 ringgit. Right? But in the market, let's say it's selling at 6 ringgit. Alright, the ideal values are only 5, but if let's say it's selling at 6 ringgit, then the company has to issue new stock. Alright, since it's overvalued, so you can issue new shares. Debt, issue debt if the company's stock is undervalued. Means it should be rightfully selling at 5, but the market is only selling for 4 ringgit 50 cents. So you issue debt. Alright, overvalued means you issue stock, undervalued means issue debt. So as a result, if a company issuing shares, right, in the market, investors might think this offering is negative. They took it negatively because they might think the company's shares is overvalued. Alright, rightfully, if let's say rightfully 5 ringgit, the market is selling for 6 ringgit. Alright, that is the situation where the managers might issue shares. Right? If not, they would issue debt. Alright? So with that, we would be completing chapter 3 on capital structure and leverage. So remember class, capital structure means the combination of debt and equity. Alright? Of course, if a company has preference shares, then you have to add preference shares as well into the combination. Right? So the optimal means the ideal combination of debt and equity. Okay. So with that, let's end the session chapter 3. Thank you.